going live. It's going to populate. It'll take about 45 seconds to populate on Facebook Live. And then also, if anyone needs a copy of the video, I can send it to them via YouTube tonight.
And you probably want to go co-host because it's asking me to admit. So do you want to do that?
Oh, yeah.
Because, you need to put me as co-host so that way you could still admit.
Thank you. Good catch. Let's see here. Okay, can you send host back to me?
Yeah. Oh, let me see. I'm sorry. Let me go back to here.
No worries.
Participants. Okay, and you are Dr. Shepard?
Yeah. Yes.
Okay. So I'm gonna make you co-host.
Yeah, that's perfect.
Co-host.
Co-host is fine. Yeah. All right. Then I'll see if I can get anybody in that wants to be. I haven't seen anybody that wants to get in, but
there's a Wayman in the. I'll let him in.
Okay, thank you.
It was a Fremont or Furman.
Furman. Oh, that's Councilman. Yeah, Councilmember Furman. Okay.
But you are able to admit people, correct?
Yes. Now that I'm co-host, yeah, I can.
Okay, cool.
All right. Okay. Let me see here. All right. Let me just make sure we're live on Facebook, and we will get this party started.
Okay.
Okay. Yeah, we're live. Okay, cool. All right. Okay, let me see. All right, it is 5:30. All right. Good evening, everyone. I'm Dr. Keithion Shepard. I am here with some colleagues from the Dreams Coalition. Some of you may remember what we are and what we do. DREAMS is it's an acronym. It stands for Developing Resilience, Empowerment, Accountability, Management Strategies. Our job, our mission is to help our community, help our people, and empower them. And tonight, one of the ways we're going to help empower is by getting into that financial literacy piece concerning tax preparation and so forth and so on. We know this has been a very awkward year. Unemployment, and how do I account for taxes there, self-employment, things of that nature. Well, we brought you a tax professional tonight who will help you navigate through those uncharted waters. With me on screen tonight is Mr. Troy Strange, Miss Anita. I'm sorry. Miss Anita, I'm sorry, what's your last name, Miss Anita? She's muted.
There she goes.
Yes, thank you so much. And then Councilmember Wayman Furman from the city of Indio, and our special guest, Mr. Raymond Delone. Now listen, I want to read his bio to you tonight so you can know exactly who he is and understand that we didn't just bring you someone off the street. We have someone with plenty of knowledge and expertise in this field. He is the broker and owner of Interstate Realty and has served hundreds of clients in the Los Angeles and Inland Empire real estate market. He also owns and operates a professional income tax service, which is called Tax Time. He's a licensed insurance broker. Raymond has been in the financial service business for over 39 years. He's the author of a new exciting book called God's Way to Prosper. I Used to Be Broke. That sounds like a great book. Raymond and his wife, Dr. Jana Webb Delone, have 2 daughters. Raymond enjoys family, investing, writing, and music. Trust me, if there was ever a person qualified to speak to us concerning issues of financial literacy, it's this gentleman with us on tonight. So without further ado, the Dreams Coalition is going to present to you and introduce to others Mr. Raymond Delone. He's had some pre-scripted questions sent to him. If you have questions that he has not answered, please put them in the chat. We'll make sure that he gets them, all right? So Mr. Delone, the floor is yours. Wow us with your information.
All righty, thank you so much for having me here tonight. I really appreciate it. So let's get started. Let me share my screen and we could get started. Let's start with this. Okay, can you guys see my screen?
Yes, sir.
Okay, great. So first of all, steps to take now to get a jump start on the taxes. First of all, tax season officially starts February 12th. So you could actually still get a jump start by getting your documents together. I've already prepared a few returns. They're just in the queue. I don't want to send them in before time because of COVID. I don't want them to get lost in la la land. So, but February 12th, the Internal Revenue is accepting e-file returns. California is accepting e-file returns. So get your stuff together, have your records organized to make preparing tax return easier. It may also help you discover potentially overlooked deductions and credit. So the things you want to gather is your W-2s from your employers, your 1099s, this would be from banks and other payers. This is INT, which is your interest statement from banks. your 1098 mortgage statement, which shows your interest. And if you have an impound account, it will show your taxes and insurance. Your 1099, a lot of people are going to get a 1099-G this year for unemployment compensation. Your 1099 DIV, which is dividends, income from stocks. 1099 miscellaneous income, which is if you're self-employed, you'll get a 1099 instead of a W-2. The thing with the 1099, there's no withholdings. You're responsible for your own federal income tax, and you're responsible for Social Security tax. 1099-R, which is your retirement account. So these for people that have pensions, annuities, those kind of things. You'll get a 1099-R for that. And then, which is really important, if you have Cover California, you're going to get a 1099-A, which is kind of a full sheet of paper, but it has what your obligations were as far as your contributions to your medical plan. But without that, if you send in a return without the 1095-A and you were in the marketplace, Internal Revenue is going to hold your return, send you back a letter saying they need the 1095 and a 8862, I believe it is, which is the form that just adjusts what you paid to what they gave you. And you either get a credit or you have to pay back money, depending on how that form falls at the end. So these are the things that you're going to get through the mail. You should get this between now or January 1st and January 31st. They're obligated to have it out by the 31st. So I advise all of my tax clients to gather all the stuff, put it in a shoebox, put it in a Ziploc bag, put it in a paper bag, put it in your drawer, whatever. But these things are important because without it, and we'll talk about that a little bit later, you're going to have an inaccurate return. And with that, you're going to probably get your refund, but you're going to get you're going to get a letter maybe up to 2 years later saying that you had missing information, that your information did not match with Internal Revenue or the Franchise Tax Board received from other payers. So it's important to get these, put them up as you get them. Okay. The other thing, if you're going to a preparer, not only do you need this, but if it's a brand new preparer, bring your last year's tax return so they could use that as a guideline. So they're not going to overlook something that you may have forgot to bring to your appointment or bring with you to your appointment. Okay, the next thing is your contribution statement. These are things still that you should get through the mail. Contribution statement, you should have that from your church. And I believe they still have the same kind of deadlines by January 31st. Everything kind of is online now. Goodwill, you normally get not a list to show the value, but you do get a list to show that you gave a contribution. You can take up to $500 for non-cash contributions, Goodwill, Salvation Army, thrift stores, or whatever, Helping Hand, those kind of things that are nonprofit. You can get up to $500 without itemizing all of the items. If it's over $500, then you have to itemize when you purchased it, what was the fair market value at the time of the gift. It's a little bit more tedious, but you could deduct it. But this is an itemized deduction, and we'll talk about that a little bit later. Also, you won't get this through the mail, but your last DMV registration, there's a license fee that's deductible on there. So you don't, normally you get your DMV, you spend $400, but all of that's not deductible. And on that DMV registration that you normally get through the mail, it tells you the amount that's the license fee that's deductible. Medical expenses are over 7.5% of your income, and we'll talk about that a little bit later. Now, people who receive the economic impact payment in 2020, and then they also gave out another payment in 2021, we'll talk about that. But if you receive the stimulus package or stimulus payment, I guess that's what they call it, it is not taxable. It's not a taxable event, so you don't have to worry about putting it on your tax return. Now, if you didn't get it in 2020 or you didn't get the one for 2021, there is a credit that's on the 1040, and we'll look at that a little bit later, but there's a line that you could apply that money that you didn't receive as a credit against your taxes due, or just get a refund back based upon the amount that you didn't receive to the maximum amount. Last year, I believe it was, let me see if I get this right. I think it was $1,000, $1,200 or something like that for the adults and $500 for the kids. It was $1,200 for the adults and $500 for the kids. This year is still $1,200 for the adults and $600 for the kids per kid under 17. All right, so that's what you could do to get started. Again, you have until February 12th. So, and all of your documents, depending on, you know, how much stuff you have going on, you may not have received everything or you may have it, but these are the things you want to look out for. So let me minimize this and go to here. All right, so that's getting ready. We just kind of talked about the Internal Revenue, IRS, delivering the second rounds of economic impact payments, which is your stimulus. Again, this is kind of saying the same thing I just said. They started sending out the checks. This was dated the 29th of December. They started sending out the checks December 30th. Now, there was an income threshold. So if you were a single person, you made 75,000 or more, you didn't qualify for the stimulus. Or if you were a married couple, I want to say it was 150. If your income for the joint, you know, whatever, the joint return, if your income was exceeded 150, you didn't receive it. So a lot of people got it. It was a kind of a shot in the arm. It was good, but a lot of people didn't get it. So that's what this is. So if you got it, it's not taxable. It was kind of cool. If you did get it, or if you didn't get it, you can't take it as a deduction, as a credit, because you didn't qualify. Okay, let's talk about how long should you keep a tax return or keep your records. Like the guest, I mean, the person that introduced me, the host, brother, I'm sorry. I've been doing this since 1980, since 1979 was my first year of doing taxes. So by me, and I started my business in 1981. So from 81 until probably 2012, I had an office and I had plenty of storage. So when I moved back home in 2012, I had all these tax returns. So I had to do a lot of shredding. So basically you only have to keep a tax return 3 years. So if you file a tax return and you have a refund, keep it for 3 years. Or if you file that tax return and you got a refund, but then you amended it for some reason, then you would keep it an additional 2 years. Basically, if you have a tax return and you have like real estate, if you have real estate like your personal property, or if you have a rental property, or if you have a business and you deducted depreciation or something like that, you want to keep it for the statute of limitation, which is 7 years. So that's pretty much it. Maximum is 7 years statute of limitation. Now, if the Internal Revenue or the Franchise Tax Board, Franchise Tax Board deem that it is fraud, then there's no statute of limitations. So again, like they said here, keep records indefinitely if you did not file a tax return, which means you had taxable income, but you never filed it because there's no statute of limitation. You might want to keep that. That kind of doesn't make sense, but that's talking about the records, not the tax return. Okay, so keep your records. That would be your W-2s, any deductions. We're going to talk about filing a tax return. It's always to your best interest to file a tax return and to file a tax return in a timely fashion. Okay. If I'm going too fast, you can slow me down. Let me see. So what happens if you don't file a tax return in a timely fashion? Okay, so generally, April 15th is the deadline for most people to file their individual income tax returns and pay the taxes owed. So now last year was a different year. I mean, out of all the years I've been doing it, I've never seen them extend the deadline. Normally, the tax return is due by April 15th. Then you have your extension, which is due October 15th for a timely return, and that's it. But because of COVID, they extended the tax deadline to July 15th. So that was different. And I'm not sure what they're going to do this year. They haven't said anything yet. But normally it's due by April 15th, which means that if you owed money, you should have paid it by April 15th. But let's say you didn't pay it by April 15th. Let's say you filed a tax return, it's a timely return, but you had a balance due, which means that they didn't take out enough taxes or you didn't have enough deductions, however you want to look at it, but you owe them money instead of them owing you money. In that case, at the time that you file that tax return, the clock starts ticking after April 15th. And then you have interest based upon that tax return at that time. And the interest rate is determined quarterly by the federal short-term rate plus 3%. And its interest is compounded daily. And I think normally the interest rate is about 6%, 6.5%, that kind of stuff. In addition, if you file a tax return but don't pay the tax you owe on time, you generally have a late payment penalty. The failure to pay penalty is 1/2 of 1% for each month or part of a month, up to 25% of the amount of the tax that remains unpaid from the due date of the return until the tax is paid in full. So it really is better to have them take out enough taxes, and you can change that or manipulate that with your W-4 for your federal tax return. And I believe it's a SS5. No, it's not S. Yeah, I think it is a SS5 for the state. So those are your withholding statements, which tells them how much, if you're married, if you're single, if you have, you know, multiple dependents, that kind of stuff. So you can manipulate your withholdings with your W-4 or your state withholdings. So there's a interest, there's a penalty for filing late. There's a penalty, let's see, so which one is this one? This one, 1/2 of 1% rate is increases to 1% if the tax return remain unpaid 10 days after the IRS issues a notice of intent to levy the property. So then Internal Revenue could actually levy your property. They could put an attachment on your wages. They could put a levy on real estate or any personal items, personal property, real property, that kind of stuff. This is what I like at the very end here. It says that often you can borrow the funds necessary to pay your taxes at a lower effective rate than the combined IRS interest and penalty rates. Now, the other thing about not paying your taxes on time is that when you do make a payment, now you could always do a payment arrangement. So let's say you file your tax return and you have a balance due and you don't have the money to pay it. At that time, you can file an installment payment. It's a form to actually have an installment agreement and with your tax return. And that allows you to kind of pick a payment amount to pay. So that's one way. But when you do that, the payment that you make goes against the tax liability first. And once the tax liability is paid, then anything over goes to interest and penalty. So the interest and penalty keep accruing until the taxes are paid, and then it start knocking down the interest and the penalties. So it's very important to file on time and pay it on time. So let's look at, let me see where I am. Let's look at a tax return. So let's just kind of, I got to get back in here. Let's get back in here. Do this over again. So if I log into a tax return, just show you a couple of things, what's new. And there are a couple of new things. So let's see, where did my tax return go to? Okay, so this is what if you filed your own tax return, a lot of people, I do a lot of taxes. I've done a lot of taxes over the years, thousands of tax returns over the 30-something years and 39 years I've been doing it. But the tax return hasn't changed a whole lot. Of course, you have your filing status at the top, you have your personal information, social security numbers, that kind of stuff. Couple of things they changed on the federal. It used to be the last couple of years, I think they winged it out last year, but they asked if you had medical insurance for the full year. They didn't ask it last year on 2019, and they're not asking it on 20, but the state is now asking if you have medical insurance for the full year, and they're penalizing you now on the state, and the federal kind of let up off of it. So this here's your standard deduction, your dependents. This is what I want to show you. There is something now, this is for 2020 returns. They started this year. Normally you either take your standard deduction, which is just a flat amount. So standard deduction for a single person is $12,400. They give you that as a deduction off of your income. So if you made $50,000, now you add 38,000, 36,000. Yeah, something like that. So instead of being taxed on the 50,000, you take off the 12,004, and that's your standard deduction.
Excuse me.
Yes.
It doesn't appear that the form, the sheet that you're speaking about is on the screen.
It does not. It's not.
It seems like it's the first sheet that you've started with is still up there.
Okay. Let me stop sharing for a second, and let me go back. I'm sorry. let me stop sharing for a second and go here. Oh, let me do this. Okay. You know, oh, here it is here. Okay, sorry about that. Thank you. Can you see it now? You can? Okay. All right. Okay, so let me back up then. So this is a 1040 2020. Again, your filing status, which has a big deal to do with your return. If you're single and married filing separately are the highest tax tables, because it's all about tax table or tax rate schedule. So these two are the highest, but single is better than married filing separately because some of the credits that you could get still as a single person, if you file married filing separately, you don't get it. So they really penalize people that file a separate married filing separately. Married filing jointly or qualified widower are in the same tax table. Head of household is kind of in the middle. So married filing joint, qualified widower are in the same tax table, which are the best. Then it would be head of household. It's forced tax table. It's less tax in these tables. And then single and then married filing separately. Again, this was just your heading that I was talking about, your dependents, and we'll talk about that in a minute too. Now, and I was talking about the standard deduction. So let me get back there. So standard deduction for a single person is $12,400. And that's, again, if you had 50,000, take off 12,004, that's your taxable income. And we'll see page 2 in a minute. Married filing joint, 24,008. So what they did a couple of years ago, and this was, and I was tongue-tied last time, but it's called the Tax Cut and Jobs Act. This was the thing, the TCJA. This is the thing that Trump initiated back in, I guess it was early 17, but it was effective on 18 return. So 18 and 19 return. They pretty much kind of butchered the tax return. I don't think it was really to people's advantage, but in some cases better, but not all cases. They doubled your standard deduction. It used to be for a single person, it was like 6,200, so they doubled it. Here it was like 12,004, so they doubled it. Head of household, again, they added some money there because it was just a little bit higher than your single. But what they did with that, and let me just go here and then I'll come back. What they did with that, it used to be you would have an exemption credit. Let me go back to one. It used to be you had an exemption credit, which I thought was a lot better for people. So let's say you had, 4 kids or 5 kids. Some people had 5 kids, 6 kids. I mean, that's a lot of kids, mouths to feed. But back in the day, you used to get like $3,500 for each kid. So, so times 5, what is that? 15, 16, 17, 1750. So that's extra $17,500 off of your income, plus you would get your standard deduction. But with this Tax Cut Jobs Act, they got rid of that, and now they give you $500 per child, or let me see, $500 per dependent. So it's kind of a ripoff in a sense, but that's the new tax law. So let me go back to what they did do was, and when I start off saying, you can either take your standard deduction or your itemized deduction. Now your itemized deduction, somebody's trying to get in. There's somebody that needs to be admitted. Your itemized deduction will give you like your medical expenses over 7.5% of your income. So this is the threshold. It has to be over that before it's a deductible item. It gives you your state taxes withheld. It gives you your real estate taxes, personal taxes, that would be your DMV again. Or if you didn't have withholding, it would give you the general sales tax, whichever is the greater. But with this Tax Cut and Jobs Act, they now have a floor here. This was instituted by Trump's administration, that no matter what this amount is, it can't be over $10,000. So let's say you are a professional, like I gave the example, my wife is a pediatrician, they take about $15,000, $16,000 just in state taxes. So right here you would have $15,000, $14,000, $16,000, whatever. You have your real estate taxes in California. I know our real estate taxes is 5 something, so we're already at 19. Then you have your DMV. The maximum you could take is 10,000. That other 5,000 or 6,000 is just money you left on the table, which would normally have went to lower your income. So this is the itemized deduction. So you either itemize or take the standard deduction. So by them doubling the standard deduction, a lot of people are not itemizing now because, you know, depending on their mortgage, if you don't have a lot of state taxes taken out, you don't have real estate taxes, you don't have mortgage interest, and you're not a tither where you're giving money to, you know, 501Cs, you're going to take the standard deduction. But so it's either or. So let's say you didn't itemize your deduction because your standard deduction was more. They came up with a charitable contribution. This is new this year, that they will give you a charitable contribution to take off, even though it's normally on your Schedule A. But the bottom line is it's not more than $300. So it's kind of pennies. So it really doesn't do a whole lot. But that's new this year. So either here you would either end up with your standard deduction or your itemized deduction. But now let's say you did itemize, then you can't take your contributions here as well. It's one or the other. Okay, so what else is new? There is a credit. Let me see, where is it? Okay, here it is here. Okay, this is the recovery rebate credit or the stimulus credit. So I was talking about that earlier. So if you didn't get your stimulus in 2020, you know, the $1,200 and the $500 for each kid under 17, if you didn't get it, then you could take it here as a credit. So that's kind of cool. You could still get it. Or if you didn't get the one for 2021 and 2021, you could take it here. So I know some people did not receive it that was qualified to get it because of COVID or whatever. So if you didn't get it, just make sure you mention that to your tax professional that you didn't get it, and you could take it here as a credit. So that's the only, no, there's one other thing. That's the only two things that are real, that's on the tax return. But there is something else that came out, which I thought was pretty good. Let's see, it's here. Can you see this, the new thing, or is the tax return still on the screen? Let me see. So let me go here.
Still see a tax
return.
Okay, that's fine. Okay, so I have to change it each time. Okay. Okay, can you see that where it says line 30, recovery? Okay, good. All right. Well, let me deal with this one. This is just a recovery rebate credit, and that's kind of what I was saying. The economic impact payment was based on your 18 or 19 tax year information. Recovery credit, rebate credit is figured on the economic payment, except that the credit eligibility and the credit amount are based on. So they saying for 2020, it's based upon 1 year. So let's say, you know, you got your ones in for 2020, but now the ones that's going to be issued now, let's say if you're doing it for the first time, it's going to be, the actual dollar amount is going to be based upon your 2020 tax return, if that makes sense. I hope I didn't just blab that out. But I want to show you something else that I thought was, let me see if I'm going to get there. I have to do it this way. There's a credit while I'm getting there, which I thought was pretty cool. There's a credit now, let's say for self-employment people or self-employed persons or people. If you're self-employed, you have to pay, and you have income over $400, you have to file a tax return, and you have to pay Social Security tax based upon any amount over $400. And it's 15.6% or 15.8%. Almost 16% of your net gain is subject to Social Security tax. So there's a credit, and it's a deferral, and it's on page 6, I'm almost there. It's a deferral where you could defer 50% of your unemployment tax that you would normally pay. So I'm self-employed, so every year, let me see, where is it? Every year I pay Social Security tax because I don't have an employer and it's not taken out. Let me see, where is it? What is that? It's on page 6. So, okay, coronavirus. Oh, here it is here. Okay, so they're letting you defer 50% of your Social Security tax. So it's not, they're not giving it to you, you know, it's just since people are hurting for money, you know, 16% is quite a bit, especially if you made a decent amount of money to have to pay that in addition to your federal tax. So like, let's say if you're a employee, your employer matches half of your Social Security tax. You pay 6 point something, he pays 6, or they pay 6 point something. That comes up with the 7.5 or whatever it is. But here you actually pay the 15%. So 15.8%. So you actually pay it yourself. So you have to pay federal tax based upon the amount of money you made. And then you're paying 100% of the Social Security tax. So basically, they kind of making it like you're an employee. I just thought about that. Instead of paying the whole 100% of the 15.8, you're paying half of it like your employer would be paying. So that's a credit. And there's a formula. I didn't look at the formula, but there is a deferral. So that's pretty cool. Even for in-home, if you had somebody like a maid or something like that, in-home domestic care, that's what they call it, domestic cares. So that's pretty much the newest stuff that's going on with the tax return. Let me see if there was anything else. It's at 6 o'clock. So let me do this. Oh, I'm sorry. I'm gonna have to go back to share. Let me show you. Let me go back to share. You gotta remember what you're doing here. Let me see. Okay. So this is my contact information. I know I kind of flew through this, but my phone number is there if you want, or you could email me as well. You know, like I said, tax season will officially open February 12th, and to my knowledge, it's going to end April 15th. And then of course, if they don't extend it, then you'd have until October 15th to still get in a timely return. You do want to file a tax return on time if you can. This is the thing too, you know, if you don't, you can kind of monitor your withholdings, but I would say probably by August, September, you should really look at your last paycheck stub and look at your tax return and see, okay, did I have a balance due, which means I owe back money? Did I get a refund? And if you do that by August of the year, preceding year, or the year to come, or, then at least you could kind of manipulate your W-4 and change your withholdings to where you could maybe bite the bullet during the course of the year and either break even or have a small balance due or have a small refund. But if you wait till December, once December 31st hit, it's in concrete. And then when you file your tax return, if you don't have the deductions, then you have that, I call it, you just digging a hole and you just putting more, you're just digging it deeper, because they're gonna hit you with the tax, with the late payments, with the penalties, with the interest. And then if you do that year after year, you can still make an installment, but it just continue to add up. So let me show you one other thing. Let me stop sharing this one. I got two more things I think I want to show you, and then I'll stop. Oh, let me go here. This is where I want to go. So sharing. Let me share my screen. Okay. Okay, this is it here. Okay, I wrote a book called God's Way to Prosper, I Used to Be Broke. And what a tax return does, a tax return gives you a snapshot of the monies you made in a calendar year. If you're on a calendar year from January to December 31st, that tax return reflects how prosperous you were, how much income you made. The tax return is pretty revealing. It tells you how many's in your household. It tells you what income was made. It tells you what source of income, wages, self-employment income, dividends, interest, capital gain. It tells you about your deductions. Did you have itemized deductions, or you did a standard deduction? It tells you if you get money back. It tells a whole lot, but it's just a calendar year snapshot. What this book does, it gives you that in the book, but it tells you how to preserve wealth. It tells you how to accumulate wealth. It tells you how to get out of debt. It tells you about tithes and offering. And the book gives you the perspective of a world's, how do you say, the practical application. So in the world, this is how it affects you, and in the spirit, and in a spiritual sense, how it affects you. So I do a lot of comparisons between how can you make, or how do you get income, wealth, and riches in the world, and how do you get income, wealth, and riches by doing it God's way. That's my comparison. So this book kind of gives you, not only gives you a snapshot of the tax return, but it shows you the things. How do you get wealth? How do you distribute wealth? How do you protect your assets? Do you have life insurance? Do you have adequate insurances? Do you have do you live on a budget? How do you strategize? So when you get your money, do you think all your money is yours? And it's only 71 pages, but it has worksheets in it. It's a really good book. So I'm promoting the book. Get the book. I believe you get the book and read it and follow the principles. No matter where you are, it shows you how to claw your way out of that and get to where you want to go. So that's my plug on the book. And then lastly, and I'll stop and hope I'm not over extending.
You're fine. You're fine.
Okay, good. Okay, good. Okay, then the last thing I want to do is I want to show you, I think it's, let's see, this one here. Okay. I've been doing a Black History program. I started January 18th, so the day of Martin Luther King's birthday, the day they celebrated. I kicked off my Black History. It's called the African American Experience. And normally we celebrate Black History February 1st to the 28th. I've been doing a Black History program or event. This is my 5th year consecutive. And since COVID hit, everything is virtual, which is actually kind of cool because I decided, which was a huge task, but I decided to do it from January 28th throughout all of January through February 28th. So I'm presenting a different segment by Zoom on African American experience. And tonight our featured personality is Ray Charles, but we have like some videos before, and then we have a featured personality, or we have something that affected the African American. So that's the Zoom link there, or you could, if you wanted to, you could just put in this 886-3291-1655, and you could join the Zoom. It starts at 7 o'clock. The only night we're off is Wednesday nights. So we're on for 6 days, off for that 1 day and back on. It's been really enlightening. And then we open it up for discussion at the end. Okay? So that's my plug, guys. I hope you guys got something out of it.
Wow. A lot of information. And for those that will watch this later, please know that we will have it on YouTube as well, so you can come back to it. Whoever your tax guy is, if they're not approaching your taxes with this information that's been presented, we invite you to show them this video and get your questions answered. I do have one question for you though.
Sure.
Because of the pandemic and people being off of work and all that kind of stuff, we've seen a kind of a renaissance of home-based businesses, and with the relaxed standards, people have turned their kitchens into places of business as well. If there was one piece of advice that you can give these people that have taken this time to create a business at home concerning their taxes, what would it be?
The biggest thing is record keeping. Record keeping is crucial. So you want to document what you spent and what you made. Those are the two categories: income, outgoing. So you want to document how much money you made. I mean, and that's the thing with taxes. You could easily be unethical, especially self-employed, because nobody knows what you made. So 1099, they report it to the Internal Revenue, but if you're basically a home-based business, nobody knows. But I believe in integrity. So document what you made, document your expenses. If you're a self-employed, everything you do to make that business a business is deductible. So your business cards, your advertising, your cell phone, if you're using your kitchen, or I have an office in a home, which I'm using here, you could write that off. So if you're renting, based upon your square footage of your office, you could take a portion of that off as a deduction of the rent. So if you're spending $10,000 a year for rent, and you got a 10% interest, square footage, you could take 10% off. Your property taxes. So for your homeowner, you can take 10% off your property taxes, 10% off of your mortgage, your utilities. It's based upon the square footage of your office compared to the whole total square footage of your building or home or whatever. Right. So record keeping, document everything, your mileage. So every time you get in your car to meet a client, drop off, go to the bank, pick up anything. It's a really good thing, because all that goes against your income. So you can, in essence, that's why business is so important. And that's why people love business, because you can make $100,000 and put $90,000 back into the business to grow it. It's all tax deductible. You only taxed on the $10,000, even though you've cash flowed $100,000. So here I had a building, I purchased a building. I could have renovated the building. I still have to spend the money. Now, the thing is, you can't keep the money, but you can spend the money on depreciable things. You can spend the money on things that's going to appreciate, and you get a tax write-off. That's why corporations are so rich. They could make the money and then they float it right back in the business and get a tax write-off. So, we really need to be more entrepreneurship. We should be out there And in fact, tonight in this Zoom meeting, I'm not sure if you guys heard about GameStop stock. Mm-hmm. Yeah, I have stock in there and it just blew up. I've had stock in there since 2017. It's just, and I bought it because I was like, okay, you know, I got hip to Scottrade back in 2015 or 16. One of my friends was telling me about it. So I'm thinking, okay, so I'm gonna start buying stock. So I'm like, okay, Walmart, Target, you know, I'm thinking, I'm just driving, I'm writing down, okay. Then I go back to Scottrade and I look it up. What is the stock? You know, what is it worth? That kind of stuff. Does it pay dividend? So I bought GameStop quite a while ago, at least 2 years ago, if not 3. All of a sudden, I looked the other day and I'm thinking, oh, I got a $4,000 gain. I look again, wow, I got a $10,000. I got a $41,000 gain on a $1,500 investment. Right. So those are the kind of things that if you know about it, and I talk about that kind of stuff, how you could get ready for retirement and that kind of stuff. So anyway, make a long story short, yes, document everything you have. And like I said, it's the best way to make a living now. Everybody don't have the heart to be self-employed.
Right.
A lot of people, they won't punch that clock and get that every week, every other week. And I haven't done that. And this is just a testimony on the goodness of God. I've had 2 legitimate jobs and I'm 64 years old. And that was only for 24 months. I could never seem to work on a job more than 12 months. I liked it, but I was self-employed and I'm thinking, I make more money doing what I do. Taxes are seasonal, and then I'm a real estate broker, and it's like, no way. I mean, even for the pension, it's like, I just can't go back to do it. I can't do it. So everybody can't do that. Everybody can't say that. So,
Dr. Shepherd, I got a question and a couple comments. First of all, Mr. DeLone, thank you for this presentation and this knowledge and wealth that you're passing on to us and all of our viewers and people who are going to watch this on our social media platform. This is invaluable information. And I do have one request first. I'd like to have Mr. DeLone back to expand on some of these things he's been mentioning as far as finances, getting familiar with the stocks, generational wealth,
right.
the wealth divide in our country. These are things that I think our viewers and our people need to really pay attention to and keep it kind of elementary so we know what's going on. So I do have that request because I like to keep going, but I know your time is very valuable. So we appreciate you. One thing I'd like for you to expand on, during the previous conversation, you really honed in on the importance of record keeping organization and keeping these things throughout the year when folks approach their tax preparer, and how important that is with the organization. Because I remember, I think your words were that I'm not your accountant, I'm your tax preparer. So exactly. I'd like you to expand on the importance of that. And thank you once again.
No problem. Yeah, I mean, a lot of people have simple returns, which means they just have a W-2. So, I mean, that's pretty simple. But in the scenario I was telling you about, this guy was a mechanic and he had all of his receipts. Now, he was good at keeping receipts, but he would just give it to me in a shopping bag, a brown paper bag, and they smell like grease and oil and everything else, and I'm thinking, man, I'm not your accountant. This is data entry, for me to sort through all of these receipts and come up with a total. That's not preparing your tax return. That's a whole sideline. So anyway, but most people returns are fairly simple. They're going to come in again with their W-2. They're going to come in with their 1098, which is their mortgage statement. They're going to come in with 1099s. If it's a first time return, then you want to see their Social Security cards and that kind of stuff to make sure the people are legitimate, that kind of stuff. But it's pretty simple. A lot of kids are doing them online, with TurboTax and with H&R Block and IRS. But if you have a fairly sophisticated return, if you have rental property, if you have royalties, or if you have a business, Schedule C, Schedule E for rental property, or something like that, you probably want to see a tax professional. It's not rocket science, not brain surgery, but you could miss some things. And then I go back, I could amend a tax return, which means I could take a tax return that's been filed, and if it's still within 3 years, you could go back and amend it and correct it. So there's a lot of money that's on the table. There's some deductions that are missed and that kind of stuff. And if you don't know, you don't know. So.
Wow, thank you.
Can I ask a question? I
Sure.
appreciate it. That was a great presentation, Mr. DeLone. I appreciate you taking the time to share that with us and the viewers. I have a couple of questions as it relates to passive income versus earned income. And I just learned this probably a couple of years ago. My tax guy was breaking it down for me. And could you tell explain the difference and how that affects us? Someone who goes out and works, trade their hours for wages versus someone who makes an investment and they are taxed on the profits of those investments.
Right. Okay. Let me share my screen because I could probably do it better with a tax return in front of me.
And while you're doing that, the other question is, I also learned this a few years back, just explaining, or has not explained, but has the income requirement changed as it relates to write-offs for real estate? I know the threshold was at 150,000 before. Has that changed any?
It has not, no. And that's if you're talking about if you a landlord, basically.
Right.
So let's say you have rental property and you could take up to $25,000 of losses against that, or maximum of $25,000 of losses on that real estate. But if your income is over 125, I believe it is. I think it's 125, if I'm not mistaken, I could check it. But if it's over $125,000, then it's deferred. Basically, you still get the loss, but it's not a direct write-off against your tax return. It goes onto a which is a good thing to look at. I got about 15 minutes, guys. I'm gonna have to cut out of here, but let me show you. I think it's what is that form? 88 something, 88. I should know, and I know this, but right now my mind is going. It's anyway, it is, I believe it's an 8850, but basically what happens is that, let me see if I'm gonna be able to close this out. Let me just choose a form for now, just to close this out. I think it's 8263. I wanna say it's 8263. But anyway, what happens is if you're over the 125, then instead of you getting, in fact, I could do it like this. Instead of you getting it on your tax returns, it go to this form. So let me pull up a Schedule E because it's going to be on here. So Schedule E is the schedule that you would declare your rental income and your expenses and whatnot. So this is what it looks like. So this is the Schedule E, supplemental income. Schedule E is used for rental property. It's used for royalties on books or natural royalties and minerals and that kind of stuff. You get depletion and stuff like that. But so here, if you had rental property, you would list, the rents received, the royalties received, and then all of your expenses based upon that property. Then it's going to be on here. And let's see. So okay, so it's 8582. So if your expenses are $25,000, up to $25,000, you get to write it off. But if your income is over the 125, it goes to this 8582, which is good because it accumulates those losses you were not able to take. And when you sell it, you get to recapture that. Okay. So now going to your question about passive income and earned income. So I got about 13 minutes. So passive income would be like dividends. You get dividends from stocks. Some banks pay you dividends, but that's really interest. But dividends is from a stock, which they give you a part of their earnings. They pay you stock. So dividends is passive income. Interest income is passive income. So that's money made on your money. So those two are not earned income. Now, pension is considered passive income in a sense because when you have earned income, you could qualify for earned income credit, but your income has to be in a certain bracket to get that extra money, earned income credit, some of those kind of things. But so only thing that's passive would be interest, dividends. You could say your pension because Social Security, but really passive incomes would be even your rental property interest income. That's passive. So you didn't earn it. You had an asset that produced income. That's passive income. Earned income is when you physically go punch a clock. You don't have to dig a hole. It doesn't. But you're earned income is basically wages, whether it's through wages, salary, tips, that's earned income. Everything else is considered passive income. Does that answer your question?
Yeah, thanks a lot. I appreciate that.
Yeah. So go ahead. I'm sorry. Go ahead.
Yeah, like Wayman said, definitely like to get you back to talk about other things that would help us from a financial standpoint. So I appreciate it.
Okay. And then one other thing, capital gain would be passive income. So if you had a rental property, you sold it, or like the stock, when you sell the stock, like right now it's sitting in my portfolio, it's unrealized. It's an unrealized gain. When I sell it, it becomes realized. That means I took the money out. At that point, you're going to pay capital gain, but still it's passive income. Okay. Yeah. All right, guys. So if that's going to do it for me, that's about all the time I have. So
no problem. Thank you for your time, and then we will schedule a part 2 to this. I think. Okay. I think after this one goes out, we'll start to get questions filtered in as well. Just thank you for your time, and you all please understand that it's very important that we get our financial matters together. Absolutely. It's absolutely important to be able to pass on generational wealth, and this is just the tip of the iceberg. He will be back. So from the Dreams Coalition, we say thank you all for tuning in. If you have any questions, inbox our church page. Any question from Mr. DeLone, we'll email him directly. And you all have a great evening.
All right. Thanks again, guys. Appreciate it. All right. I'm out. Thank you.
Yes, sir. Take care.
All right. Take care.